guess what? We had a nice op-ed today in the Wall Street Journal.
Yes, we did. That's the first of the three things that we are watching here this morning. It has to do with the outlook for the Federal Reserve and what's going on with the U.S. dollar. The dollar is something that Jared has been flagging for weeks now. It's something that's really been a driver of the market. And the latest catalyst for the dollar came this morning, indeed, in the form. It wasn't actually an op-ed. It was just a story in the New York Journal, the New York Journal, the Wall Street Journal, by Nick Timrose, who tends to be someone who is closely associated with the Federal Reserve. And when he writes something, even though it is not an op-ed, it is seen as really reflecting the views of the Federal Reserve. And what he wrote this morning is that the Fed feels the market is not necessarily getting the message about the next rate increase being a 75 basis point increase, and that the Fed was disappointed. I want to read this graph real quickly. Officials have been uncomfortable by how the markets rallied, easing financial conditions following their July 26-27th meeting, when Mr. Powell at a news conference signaled the central bank would at some point slow its rate rises. So that not tightening of financial conditions is not what the Fed wants to see right now.
That's right. And this is a rally that we're talking about. Right after that late July meeting, we saw liftoff, and we got that into the first 2 weeks of August. Of course, the 2 weeks since then, we've seen a bit of a decline here. But just wanted to show you what's going on with the Fed fund futures and what rate expectations are for that big Fed meeting that we're getting in 3 weeks. Now, earlier today, the chances of a 50 basis point rate hike were about 20%, 25%. And the 75 basis point was a bit lower. Now it's 85%. So all of that is getting baked in, and we're seeing this have an adverse effect on the risk markets. And you get back to, I'm just going to spend 2 seconds on this, but I do want to show the 13-week T-bill rate once again, because I think this is key. This is a very short-term rate that the federal funds rate is pretty much in line with, and this is up an astounding 11 basis points. Now, the Fed wants to see the terminal rate of their rate hikes around 4% maybe. 3.5% is a big number too, but you can see we got some room to go there. And as this screams higher, we've seen risk assets kind of fall by the wayside, Julia.
Well, but and to this point, we have seen some tightening of financial conditions, but we haven't seen perhaps as much risk come out of the market as the Federal Reserve would like to see. That's reflected in the fact that, yes, we had a pullback in stocks, but it wasn't that steep of a pullback, perhaps, in the past few weeks. And that maybe when you look at longer out the yield curve, we're not necessarily seeing perhaps what the Fed wants to see. I don't know. It's an interesting conundrum, perhaps.
It's a conundrum that we only have to report on. We don't have to deal with. But I will say this. The 30-year yesterday took out its June highs, and it has screamed higher as well. Although you can see it's taking a little bit of a back seat. So the yield curve is actually flattening. You have the long end over here, the 30-year, and you have the short end screaming higher. And guess what? These two converge at some point. 3.5%, that's a big number that we've been talking about. 4%'s up there, too.
And now it's in sight.